Okay, everybody, welcome to the first Cassandra Quarterly Forum of 2026. We have a great lineup of speakers today. I'm very excited. And to kick us off is Dr. Nalebuff, who many of you already know because of his work in game theory, especially his books on it. But actually, he's coming here to speak about his life cycle investing proposal, which lies at the foundation of the collective compounding machine initiative that we're going to launch with our credit union. So Dr. Nalebuff is a game theory and economics professor at Yale, and he's been basically the thought leader on this life cycle research. And he's gracing us with his presence today to talk about the details of the proposal. And I'm very excited because he shows the caliber of research that we engage with at Cassandra. Dr. Nalebuff, I'll pass it over to you. Thank you so much for coming today.
Thank you for inviting me, and thank you all for being here. This is work that I've done with my longtime friend and collaborator, Ian Ayres. And if you hear some background noise, it's basically I'm here for a funeral. So there's all sorts of family members, but there's a very simple idea in finance, which is you don't get paid extra for taking unnecessary risk. So if you put all of your money in one stock rather than a diversified portfolio of stocks, you're not going to get a higher return for buying that one stock rather than the portfolio of stocks. And we know this idea of it's boring, but effective of just buying the S&P 500 or buying a worldwide portfolio of diversified stocks. There's another type of diversification that people miss, and that is the idea of diversification across time. So let me introduce you to the most basic concept, which is the idea of $1 year. And $1 a year is $1 in the market for 1 year. And so if I told you had 3 years to invest and $6 years to allocate, how would you allocate those $6 years over 3 years in the market? So actually, since I've got Lorenzo as a possible respondent here, let me pick you for this, Lorenzo. So you got $6 years to invest in 3 years. What are you going to do?
Yeah, I got $6 years to invest, and I got
over 3 years. How are you going to allocate those $6 years?
Yeah, one way I could do it is to put $2 in every year.
Okay, and what's the other alternatives that people would pick? 1, 2, 3. $1 in year one, $2 in year two, $3 in year three. Let's look at the variance associated with those two activities. The variance goes up the square of one's investment. So 1, 2, 3 has variance 1 squared plus 2 squared plus 3 squared, which is 14. 1 plus 4 plus 9. 2, 2, 2 has variance 4 plus 4, or 12. And so doing 2, 2, 2 ends up with less risk, less variance than 1, 2, 3. They both have the same expected return. And how do I know that? Because what your expected return is whatever the return is on each dollar year. So you get 6 times dollar years of the return for each dollar year invested. So 1, 2, 3 is going to give you, roughly speaking, 15, 17% more risk than 2, 2, 2. For the same reason that you want to allocate money across different stocks, you want to allocate your investment over time equally in each year. Now, why is it that people then don't do 2, 2, 2? And the answer is also obvious. They don't have 2 in year one. They start with no money. And so they put $1 in year one, they put another $1 in year two, they put a third dollar in year three. And so they have a pattern, which is 1, 2, 3. That's how they get their $6 years. You can think of those years really more as decades than you can think of them as years. And so when you're in your 20s and your 30s, you have very little exposure to the market. You have medium exposure in your 40s and 50s. And then in your 60s and 70s, you have a very large exposure. And what we want to do is increase your exposure when you're young and decrease your exposure when you're older. So then the question is, how do you get the 2 to invest when you're young, when you don't have 2, you only have 1? And the answer is that you can invest with leverage. You can invest using some margin. And people think, oh my God, big margin on the market, that's so risky. I could lose it all. Actually, people buy houses with 10 to 1 margin. And so the idea of 2 to 1 margin is not something that is really outrageous. In fact, actually, we've done our simulations, and with some rebalancing every quarter, we, at least looking at the historical record, found that you never ended up going bankrupt. That is, you didn't get wiped out. Okay, why don't people do this? Because I will tell you, when we wrote this book, it was just a flop. There were people who accused us of all sorts of just impropriety. This is insane. You are encouraging people to lever and lose everything. And again, I want to say that we're not trying to get you to go from 1, 2, 3 to 2, 4, 6, 2, 4, 6, 8. Who do we appreciate? No, we're not trying to do that. The idea of the 2 in the first period balances with the 3 going down to 2. 1 goes up to 2 and 3 goes down to 2. If we haven't increased your lifelong exposure to stocks, then we aren't increasing your risk. In fact, we're decreasing your risk. So what are some of the issues that people have beaten us up over? One is that if you're young and the market goes down, say, by 30%, and you lose 60%, you will be so shell-shocked, so burnt out, that you would decide, I'm never going to invest again. And then you go from 2 to 0, 0. And that's a big problem. So you have to understand that this is a possibility. On the other hand, yes, it's true you can get shell-shocked if the market goes down by 30% in your first year. But the alternative is that if you do the 1, 2, 3 that people normally do, and the market goes down by 30% when you're in the 3 period, really losing a huge amount of money. And you'll have no time to ever recover from that and do anything else. And so what we're doing is putting all the risk, the majority of the risk, in our later years. And it's true, you might be so shell-shocked you won't invest again. But guess what? It's too late to do anything about it. There goes your retirement savings. If you're the psychological type that knows that this consequence would be debilitating for you, then okay, perhaps you shouldn't do that. Another feature of this is that the markets, the investing firms, don't make it easy for you. So companies like Fidelity and Vanguard charge a really interest rate when you borrow stocks on margin. And the good news is there are companies like Interactive Brokers that charge a much more sensible margin rate. So one way to do this is to borrow on margin, and not, again, we're not trying to go to 3-to-1 leverage, just a 2-to-1 leverage. And by the way, you can then go, as you get a little bit older, to 150% leverage, then 120%, then 100. Something else to consider is that you could just go to 100% when you're young. So one of the things that we also rail against is that these life cycle funds have an automatic adjustment of your exposure to equities. And it's often something 120 minus your age. And they start at maybe 80% or 70% equities, 20 or 30% bonds. And that's also insane. It should be 100% in equities. By the way, I am not a financial advisor. I'm giving you what economic theory and finance theory says, and please understand that fact. The basic idea is that you want to have a constant exposure of money in the market. And so think about this in your own experience. I predict for almost everybody on this call, they have more money in the market now than they had 10 years ago. And what that means is that they've missed 10 years of opportunities for diversification. My grandmother, bless her heart, when I was born, gave me a bond that would mature when I was age 15. And that was her. But the thing is, when I was born, I didn't need any more exposure to bonds. I needed more exposure to stocks. If instead she had bought me the equivalent amount in the S&P 500, it would have been radically better. In fact, it probably would have been 10 times better at the end of the day. And the way to think about this is that when we're young, all of our human capital is tied up, all of our money, our capital is tied up in ourselves, our human capital. And what we do over time is convert human capital into financial capital. And the problem is there's not a really good market for borrowing against my human capital. And so therefore, I can't get the same exposure. Now, think about what happens with housing. Why is it that most people's majority of their wealth comes from appreciation in housing? It's because when they're young and they buy a house, let's say with $60,000 down, and it's a $600,000 house, they're getting the returns on that full 600,000. And so therefore they're getting a constant $600,000 exposure to the housing market over those 10, 20 years, as opposed to a exposure on 60,000. And it's that much larger exposure to the market, which is allowing them to get the returns, which then allows them to retire. And the challenge we have with stocks is that because there's no leverage, there's really no exposure when you're young. Imagine if instead with housing, you had your first year exposure of 60,000, then 70, then 80, then 90, the amount of returns you would ever get on housing would ultimately be a whole lot less. And you'd all be exposed to what happens to the housing market at the end of your life, not what's happening during the early periods of your life. One more cautionary aspect to this is that you do want to think about what your risk preferences are and what you think the current return on the market is going to be. And therefore, you might think about something, the Shiller 10-year historical PE ratio. And when that ratio gets particularly high, then you might think you want to have a little bit less exposure to the market. When we wrote the book, this was right after the crash, and people, again, thought that we were insane. I'm not trying to pretend we were market timers. We weren't, but boy, was that a good time to follow our advice. And I have to say, I'm particularly a bit nervous about what's going on now in the world. But that said, I try not to be a market timer. And so ask yourself, if you were unconstrained in terms of your ability to borrow, how much money do you think you're going to have in the market as you get into your 50s and 60s? And then say, I'd like to have a little more today and perhaps ease off a little bit later on. There is one exception to this that I want to emphasize, which is if your human capital is very much connected to the stock market, then you are exposed to the stock market through your human capital. So I'm a professor and my salary is not going up and down with the market. But if I were a stock trader, if I were somehow involved, I don't know what another example would be, but if my salary is very much responsive to what's going on in the market, then I do have market exposure through my human capital. Okay, so I've gone on for a while. I'm sure there'll be lots of questions, and let's open up and see where things take us.
Thank you, Dr. Nalebuff. Yeah, we have a bunch of audience questions that they submitted beforehand, so we can start with those. And for anybody else who wants to ask a question, feel free to put them in the chat. So first, I want to really thank you again for coming to speak about this idea. It sounds more provocative than it really is at the end of the day. Like you said, we have normalized the amount of leverage in the housing context when people do mortgages to buy a home. But certainly there should be an option to do a mortgage on an index fund. And so the first question I want to ask you is, how would you characterize the difference between your life cycle investing proposal and buying a leveraged ETF for the S&P 500?
So one of the challenges of the leveraged ETFs is that they are rebalancing on a daily basis. And what that means is that volatility in the market ends up costing you a very large amount. And essentially, when the market goes up, you have more exposure to the market than your 2-to-1. And so you start selling. When the market goes down a little bit, as a result, there's a very high price that needs to be paid for the leverage, not for leverage, for the market volatility. And so these 2-to-1 ETFs, or worse, the 3-to-1 ETFs, end up having a significantly reduced return, and they don't get anywhere close to twice the return on the S&P 500. I understand why they need to do this, because when you have new money coming in, they want that new money to be exactly also at the 2-to-1 leverage. But in some sense, what I want you to do is have a personalized 2-to-1 ratio, and you don't have to rebalance it every day and thereby avoid some of the penalties associated with volatility.
Absolutely. This also starts to interact with the concept of dollar cost averaging. So can you take some time to also discuss how this is not a one-time investment? Like your model is supposed to be that the individual investor he's continuously buying into the index. So the volatility in some way works in favor, because if the market is down, you get to buy more.
Yeah. Again, I'm not actually proposing dollar. There's one other problem with the leveraged funds, which is they also charge high fees. And we know that high fees always just come out of your investor's pocket. And those things really do add up over time. Remember, let's go back to the 1, 2, 3 example. My view was that you have some amount of money that you're putting in the market every year, and you're not paying attention to whether the market is up or down. You're not trying to do dollar cost averaging. You're just saying, I have my one to put in. And if you put in your one and you leverage it 2 to 1, then you have $2 exposure in year one. Next year, you put another one in, and that gets rid of the leverage. And then the third year, you have 3, but you only invest 2 in the market that year. It's just simply the constant investment in the market is what I am proposing here. And actually, I should have said the 1, 2, 3 in reality is much more like a half, 1, 5. That is basically people are not even coming, their salaries go up, their incomes go up. They're trying to do things like saving for a house. And so the amount of investment in the market doesn't actually rise linearly. It rises quadratically or exponentially. And so the situation is much worse than 1, 2, 3 if it's a half, 1, 5 or something, or a half, 1, 4.5 to make them sum up to 6 again. But the nice thing is this is a set it and forget it. It's just what you have to put in the market, you do without paying attention to whether or not the market is high or low.
Absolutely. It's a great reminder of the principle. Time in the market is much more important than trying to time the market. You want to be in the market for a long time.
And that time in the market is exactly this notion of dollar years, by the way. It's how many dollars in the market for how many years. And that's the key notion is I'm not going to change your total time in the market, but I'm going to try and reallocate it.
Absolutely.
Now, this strategy doesn't work if the cost of borrowing is too high, because you're gaining diversification, but you're paying a cost in terms of the borrowing money. And the nice thing about 2-to-1 leverage is that's not so much leverage that they charge you a high interest rate. Whereas if you're trying to do 3-to-1 leverage, then there's some risk, because at 2-to-1 leverage and their ability to close you out, they essentially have no default risk. And so that's why it doesn't cost that much to borrow at 2-to-1. The other way you can do it is through deep in the money call options. So if the index is at 100 and you buy a call option at 50, then essentially the cost of that call option is going to be $50, because the chances of you not exercising it are almost zero. And so what you're going to be paying for in the call option is really the interest rate on the $50 that you haven't yet put in the market. One challenge, of course, with all of this is that you do care about taxes. And often these 401k plans or IRAs may have some restrictions on your ability to buy options. So it has to sometimes be a self-directed IRA, or perhaps Lorenzo's bank program will just allow people to do this in a way that's much more cost effective.
Yes, which gets us to one of the very important differences of implementing your proposal in a credit union context as opposed to a traditional banking context, is that credit unions are owned by the members, which means that even the interest you pay on your loan, it goes back to the members. So it actually feeds into the ecosystem as opposed to the money being taken away as a transactional cost. So if people pull together to do these kinds of loans to each other. Exactly.
And I love mutuals. I served on the board of Nationwide Insurance and Mutual. I have to say, mutuals should have a competitive advantage in the market. And it used to be that everything was mutuals, banks and insurance companies. And I don't really understand why mutuals have not just taken over. But I'm glad that some of the folks are out there helping keep them alive, because they should be the better way of doing things.
Absolutely. Because if you look at the way the mortgage rates offered by credit unions versus the mortgage rates offered by for-profit banks, credit unions almost always have a way better deal. And conceivably, it would be very similar. A Lifecycle Investing loan would be much better terms coming from a credit union than coming from a for-profit bank. Absolutely. Another question that our members asked is, what are your thoughts on Basic Capital, the startup that appears to be trying to do a lifecycle investing as a service? If you had a chance to interact with them?
At one point, I did look at it. Can you remind me a little bit more what they did? Something that was a little funky that I'm trying to remember what it was.
Yes,
So
yes. Let,
remind
let
me
me
some of that.
pull up, because if you look at, you'll find the rates that they charge a little concerning, but I'm going to pull it up for you now. But yeah, basically, they allow you to lever up on your index fund exposure. And it's just you described, they make the same argument that it's better than a leverage ETF because there's not daily rebalancing. And so
Okay.
the volatility drag doesn't cost you anything. But they charge a fee to the financial institution, to the broker. There is a software as a service fee, and there's a percentage as an asset under management fee. So it's a free fee structure. So you're not paying. So that's how they're able to lower the amount of money they would charge on the loan directly, because they're also able to charge the other intermediaries in the transaction.
There was something else though they did that was funky. I'm trying to remember. It wasn't just a normal loan in some way.
Yeah, let me see if I can pull it up.
I'm not seeing anything on my screen, so you could be sharing your screen, or if you.
I'm still searching it. One moment.
What is it called? And I can look too.
Yeah, it's called Basic Capital. Let me post. I'm gonna post here the link in the chat here, because their pitch is almost as an enterprise tool.
Can you tell me the website? Because I'm actually still not finding it.
Oh, I posted it here in the chat.
Sorry, okay,
Basic
I'll
Capital
find
for
it.
Employers. Yes. Yeah, and if you look at it, that's why they offer it as a service also to the employers, so they can offer it as a benefit to the employees.
I found their website. So let's look at the learn more. They're doing a 4-to-1 leverage. For every dollar you contribute, we invest $4 alongside you.
Yeah, it looks like it.
So that's a substantial amount. Oh, what they do that's weird. They do some amount that you don't lever and some amount that you lever at 4-to-1, or you get basically 5-to-1.
They split it. Okay, interesting.
And so it's a very peculiar way of doing this. And so because some fraction is super leveraged and some fraction isn't. And I don't know why you would do it that way. That was the weird thing.
You mentioned in the talk that part of the reasons to why the leverage ETFs have to do the daily rebalancing. No, sorry, this is actually a different comment you made. You said that 2-to-1 leverage is cheaper than 3-to-1 because it's easier to liquidate you in case.
And so what they're doing here is 5-to-1 on let's say half your money, and so therefore there really is risk for the 5-to-1 leverage, if you'd like. Are you following me or not?
Sorry, could you repeat yourself? You froze a little bit.
So what they're doing is a 5-to-1 leverage, but not on all your money, on half your money. And so in the end, half at 5-to-1, half at 1-to-1. Can't remember what that would be. So I would have, I guess that's 3-to-1 when I do it all together, because half of times 5 is 2.5 times 1 is a half. Add that up, it's 3. On the 5-to-1 is done in an LLC. And that LLC therefore had limited liability, so you can't end up losing any money on that part. But the chance of, with 5-to-1 leverage, of that going to zero is not anywhere near zero. It's actually quite substantial. And therefore you have to pay a lot of risk premium on that, because the person who is on the other side of that could lose money. And so therefore it ends up being expensive.
Which is ironic, because if this was treated as, there was an automatic lockup for 30 years, right? An index fund is actually home where it's going to compound over time.
And here's something else. Besides charging you a 0.5% service fee and 5.46% financing costs, which is fine, they're also taking 5% of the gains.
Yeah, this is I pulled up the...
And 5% of the gains, that's real. Anyway, so I'm not sure how cost effective that is. We should certainly go and do a Monte Carlo simulation on that, which I haven't done.
Yeah, gotcha. But yeah, for the audience, here is the basic capital fee structure. I don't know if they've changed it since then, but this is the latest one that I could find. They have a subscription fee, they have the management fee, and then they have the financing cost.
Yeah, they add up.
They really do add up. Okay, so so this is in the context of doing this very long-term kind of investing. Have you given any thought about the difference of implementing this in a Roth IRA or 401k? Context?
Those are the best way to do it, because then I don't have to worry about taxes in terms of realizing gains or not, because taxes are always an important aspect of figuring out how to do your financing. And one of the challenges if you did it with a call option, you have to at some point exercise the call when you roll it over, and there could be significant tax consequences associated with that. Yes, I'd be able to do it in a tax-free investing vehicle. Yeah, so maybe that's something your credit union could do for people.
You're on the right track. Yeah, because we very much, our hypothesis is that if structured properly, the advantage of doing it in a tax-free vehicle more than compensates for the cost of the loans, basically,
Well,
especially
it
along.
depends on how you're doing it, but there, if you're worried about the idea of actually, in some sense, how much can I lose, doing it with the call option has that nice feature that never go negative with that. So you don't have to worry about that. But then you have these issues of exercising and paying tax on it. It gives you a little bit more flexibility in terms of how you're doing this. And similarly, when you have to adjust your portfolio for rebalancing, again, there could be tax consequences associated with that. Doing it all in your 401k or IRA seems to be the way to go.
Overall, Dr. Nalebuff, what do you think is the most misunderstood part of the life cycle proposal?
As I said in the beginning, it's people think that we're doing this to increase your risk because you're investing with leverage early on in your life. And it's exactly the opposite. Yes, you're taking on more risk when you're young. You're taking on so much less risk when you're old that, in fact, your lifetime exposure of risk is going down. And that by averaging across time, you end up doing so much better. Let me add take a slight tangent for a moment, since you started talking about IRAs. And people have misunderstood a key thing about Roth versus regular IRAs. And I'm a big fan of the Roth IRA compared to the regular IRA. And the reason is that the Roth IRA lets you have a lot more money in your IRA. So let's imagine that you put $10,000 into a regular IRA, and that's the cap. That's the most you're able to put in to this IRA. And that's a SAP or whatever the rules are, and you figure out what the number is for you. But I'm going to use 10,000 because it's easy to talk about. And you get to put more in because it's tax advantage. If you convert that regular IRA to a Roth IRA, and let's say that you would then have to pay 30% taxes on that conversion because that was tax advantage. If you paid that taxes out of the IRA, it's a total wash, because this is the nice thing about commutate. The multiplication is commutative. So in the end, you would have 0.7 times the amount in your IRA times the return, whatever it is over time. Whereas alternatively, if you just kept it in the IRA, you would have what's the amount in there times the return times 0.7, because you have to pay the 30% taxes either at the beginning or the end, and it makes no difference. Now, people say you should put it in when you have a high tax rate and take it out when you have a low tax rate. So I was cheating a little bit by having the same tax rate, both at the beginning and at the end. But you also have the ability to pay the taxes on your IRAs using money outside of the IRA. And so if in the end you pay that $3,000 of taxes using money that's coming from somewhere else, then in effect, what you've done is increase the size of your IRA from 7,000 after tax to 10,000 after tax. So you've effectively added another $3,000 to your IRA. And so therefore you can make your IRA bigger and have just a whole lot more exposure to tax-free compounding if you use a Roth IRA. So if you're in the fortunate position where you have the resources to invest more money in an IRA, but are limited by the caps, then essentially paying the taxes now is effectively putting more money in the IRA. That basically, if it's a regular IRA, I effectively only have exposure from 10,000 to 7,000. But if it was after tax, it was a Roth, then I have the full 10,000 exposure. And so by paying those, it's almost as if I put another $3,000 into the IRA and then use that $3,000 to pay the taxes on it. And so that's an aspect of Roth IRAs that people just have not focused on, is it allows you to have your IRA be almost 50% bigger in terms of its size.
Absolutely. And there's also an element in this conversation that we're also not talking about just cash in these accounts. These are assets that compound. So the ability to not have to sell, right, to pay the taxes is meaningfully changes the conversation.
Yeah, I'm assuming you're going to put all this money in the IRA into equities. Now, for people who are scared of what I said and still are not ready to act, you can go to 100% without any leverage whatsoever. And 100% is better than 70% or 80%. That's at least the way to get started in this if you're not so comfortable.
Yeah, it can be gradual, absolutely, depending on risk profiles and risk preferences.
Yeah.
And
Yeah. And if you go to 120%, that's still better than 80% and maybe not up to 200%.
yeah, this was
Do we
great.
have time for one last question or not? You tell
We're
me.
going to transition to Dr. Rothschild's presentation.
Great.
But Dr. Nova, thank you so much, especially given everything that's going on with your family. We really appreciate you being able to come here and present about this. And truly, thank you for all the research that you and your colleagues have done on this issue. It's been a major source of inspiration for one of the flagship programs we're going to have in our future credit unions. We're just really grateful for this research.
And I hope I'll have a chance to keep in touch and let you
Absolutely.
know how we are doing in this and see if we can be helpful. That would be our pleasure.
Thank you so much. Have a great day.
Take care.